Hello, everybody. Thanks for joining us, and welcome to this Oxford Economics webinar. Today, we're going to be talking about our global outlook and the implications for the emerging market assets. For those of you who are new to Oxford Economics, as a brief introduction, we were founded in 1981 as a commercial venture with Oxford University and are now one of the world's leading independent global forecasting and advisory firms, providing analytical tools, forecasts, and reports on 200 countries, 100 industries, and 3,000 cities. Before we get started, just a few housekeeping points. Marcos and Aryam will be beginning their presentation in a few moments, but at the end, afterwards, we're going to be following that up with a question and answer period. And you can ask questions at any point during the presentation by clicking on the chat box and submitting to either me, James Mills, Marcos Casarin, or Aryam Vazquez. And like I said, you can do that at any point through the presentation, and please do. We're happy to take them at the end. And without further ado, Marcos Casarin.
Thank you very much, James. Welcome everyone to our webinar. I am Marcos Casarin. I'm Senior Economist here at the Global Macro Services at Oxford Economics in London. Joining me from New York City is Aryam Vazquez, our Senior Economist and Lead Strategist for Emerging Markets. So the plan for today is to present you with our latest forecast for the global economy. And then I'll pass the ball to Aryam, and he's going to talk about the implications of those forecasts to emerging markets assets. So the agenda for today is the following. We're going to be talking about monetary policy in the advanced economies. So who's going to hike first and who's going to hike the furthest. Then we move on to Europe, where we briefly discuss the implications of the ECB's QE program for the euro exchange rate against the dollar and also for bond yields. Then we're going to talk about the dollar a little bit and its implications for the US economy. Then we move on to the emerging market space, where we're going to discuss the future of the yuan, if the People's Bank of China is going to allow the yuan to depreciate. And then we're going to talk about growth in the emerging markets. After that, I'm going to hand the ball to Aryam, and he's going to discuss the implications for EM assets. So let's start with monetary policy. We think that monetary policy in the advanced economies will start to normalize this year, finally, after about 6-7 years of rates being constrained to the zero lower bound. We think that the U.S. Fed will lead the pack. So our U.S. team already expected rates to be lift off in September, and this view remains the same after the FOMC meeting a few days ago. Following the Fed will be the Bank of England, who we expect to hike rates around February next year. And as you can see from the chart, we think that Bank of England rates will rise more gently than U.S. rates. Meanwhile, we have the European Central Bank heading the opposite direction. They just announced a quantitative easing program, and we won't expect any rate hikes before 2018. And Japan, well, Japan will just keep as it is, rates at zero for at least by the end of the decade. So the rationale, according to Greg Day for U.S. economists, is that inflation will reach its trough around June, July, and then the Fed is going to wait for further wage growth and better signs from the labor market in order to start hiking rates. In the UK, the Bank of England will hike more gently because monetary policy will be offset by a tighter fiscal stance, and the Bank of England is also cautious about the implications of higher interest rates for household debt. So moving on the discussion to Europe, what we saw on the chart and the previous slide, we can see it in a slightly different way on the chart here on the left-hand side. So in blue, you have the euro-dollar exchange rate in the right-hand axis, and in red, you have the interest rate differential as measured by two-year swap rates in euro versus the US dollar. So what you see there in the left, in the red line is the spread between euro and dollar, as this spread is negative, and markets expect this spread to become even more negative as we move on to the second half of the year. This view is shared by us, and we think that this negative interest rate differential will be a key support for further euro weakening. And we expect, as you can see on the chart on the right-hand side, the euro to reach parity with the dollar in the third quarter as the Fed tightens policy. We think that portfolio relocation will be the main force driving down the euro. European banks will have to sell bonds to the ECB because the ECB is buying government bonds from them, and they'll have to buy something else. We think that this something else may be corporate bonds, but maybe also bonds, other fixed income bonds in other parts of the world, especially safe haven countries. So we expect an inflow into the US and also into the UK. So this is the force driving our euro forecast. Meanwhile, the purchases by the European Central Bank will push 10-year bonds in Germany close to zero. So as you can see, the chart on the left-hand side shows you the expansion in balance sheets in the big central banks in the world at the moment. So we expect the balance sheet of the ECB to go beyond its previous peak in 2012, and the balance sheet of the Bank of Japan will increase about 15 to 20% of GDP every year. So the increase in bond purchases from the ECB, the 60 billion a month, will have a downward effect in German Bunds. So we expect yields in German Bunds to reach almost zero by mid-year, whereas we expect the rate lift-off in the Fed to cause 10-year Treasuries yields to go to 2.2%. So this differential in bond yields, US versus Germany, as you can see in the chart below, is now at a 25-year high. So since the German unification in 1991, this spread hasn't been so high. And we expect this trend to continue in the future. But what about growth? So we have a chart here on the right-hand side where we describe GDP growth in the advanced economies. So leading the pack is the US. We expect 3% growth this year, but not much far behind you have the UK. And then comes Eurozone. We think the Eurozone is going to surprise on the upside. I talk quite frequently with our Eurozone team here, and it's mainly driven by Germany. We're particularly optimistic with Germany. So we expect 1.6% growth for Eurozone this year, which is quite strong for European standards. And this growth will be underpinned by Germany, which we expect to grow by 2.4%. 2.4% may not seem amazing if you're comparing to the US or the UK, but it's a full percentage point above the German finance minister's own forecast and well above the consensus. What we believe is that it's going to be a consumer spending story. Ben May, our German economist, was telling me the other day that real personal disposable income in Germany will be the strongest this year in several decades. So, of course, German consumers will save a portion of it, but they will also spend, and consumer spending will underpin the recovery. And then it comes Japan. Japan will post some decent growth this year, 0.9%. Growth will be underpinned by a confluence of factors. We have loose monetary policy, we have a postponement of the tax rate hike on consumer goods, and also a weaker yen. And then we move on to the chart below, where we break down world GDP growth into what is accountable for China, US, Eurozone, and other countries. So as you can see, as we move on from 2014 into 2015, the share of US into this global growth will increase. But not only the US, the Eurozone will gain some prominence as well, whereas the importance of China will gradually decline. So we see this trend that global growth will become less dependent on China, as dependent as it has been in the US, and Eurozone will also provide some support. So overall, it's a story of a broad-based global recovery. So just touching the point on the stronger dollar, we just said that we expect U.S. growth to accelerate to 3% this year. It's underpinned by several factors like stronger employment, wage growth, which we expect to pick up, around the second half of the year, and also stronger confidence and housing activity. But there are risks to this forecast. And which risks are these? One of the key risks that Greg Dacre, our U.S. economist, has identified in the research briefing about a month ago or a few weeks ago is the strong dollar. So we saw that the greenback gained about 25% against the yen, 20% against the euro, and 15% against the pound since last July. And we expect this trend to continue somewhat. We already include a 10% appreciation of the US dollar against its main trade partners to the end of the year. But Greg Dacre used our global economic model to simulate, but what if the US dollar gains 10% further? So overall, the simulation results point to, obviously, a strong dollar will give a smaller contribution from net exports to growth. This would impact business investment as well. Consumption wouldn't be that much changed because inflation would also come down, so real income would probably remain a bit unchanged. But most importantly, a stronger dollar would push back the Fed rate hike by 1 quarter to the end of the year. So that would offset some of the negatives. Overall, if the dollar appreciates 20% rather than 10%, so a 10% additional appreciation to the end of the year, this would impose a 0.4 percentage point drag on GDP growth. But that's just a scenario, it's not our baseline. So talking about currencies, let's move on the focus to China and to the yuan. So will the People's Bank of China let the RMB depreciate? Well, China saw record capital outflows in last Q4, resulting in a decline of $30 billion in reserves. So we believe that capital outflows and a more moderate economic prospect, something that we share, and I think we bucked this trend about last year when we cut our forecast for China, means yuan weakness. So far, the central bank's response has been to ease reserve requirements for banks in order to try to pump more yuans into the system and not cause a monetary tightening. And aside from cutting reserve requirements, we also expect more interest rate cuts in the coming months. Rates are now at 5.35%, and we expect interest rate, the one-year lending rate, to reach 4.85 by the end of the year. We also expect the yuan to weaken to 6.40 per USD by the end of the year as well, which should also help to boost growth a little bit, as it's going to ease pressure on exporters. Now turning ourselves to growth, that's where I'm going to end my presentation here and then hand over to Aryam. Let's just make a few comments. India has revised its national account about a month ago, and as a result, India is now the fastest growing emerging market in the world, no longer China. So we expect 7.5% growth for India this year, well done, which will be followed by China with 6.8%. We had 6.5% a few months ago, but after the decline in oil prices, we upgraded by 0.3 percentage points. And we still remain below consensus, below the government estimates, based on a detailed research that our Asia-Pacific team did on the drivers of total factor productivity and medium-term prospects. And we also developed an alternative GDP indicator based on retail sales and balance sheets of companies that points to a sharper slowdown. So China to grow below 7% this year. We see some signs of turnaround in Indonesia. I think Indonesia is a success story. The external debt is narrowing, GDP is accelerating, so it should be there in the podium, the top 3 of emerging markets. And then that's when the emerging market story starts to turn ugly. Then you have the likes of Russia contracting by 6.5% as a result of sanctions, balance of payment crisis. We have Brazil that will remain stuck in a recession for the whole of 2015, probably a positive growth in Q4, but I wouldn't hold my breath. And this means that BRICs growth will be the weakest since 2009, even though India has been revised up. So BRICS growth will be 4.1%, and if you exclude 2009, which was the world recession, then that is the weakest pace since 2001. As you can see from the chart below, we also have been revising down our EM's growth forecast systematically over the last couple of years. So with that, I'm going to pass the ball to Aryam Vazquez, who's going to join from New York. Aryam, please jump in.
Sure. Thank you very much, Marcos, and a very good day to all. I want to thank you for joining our call today. My objective is basically to share some views and some insights, both from a macro perspective and from an investment strategy point of view, with a particular focus on the EM universe. Of course, the EM outlook has been the subject of incredible concerns in recent months, and it's an increasingly dire outlook across this area of the world, which at this point not only has investors abandoning their foray into EM asset class, but there's a great deal of speculation now on the prospects of another EM crisis. We, for one, believe that the EM is not anywhere near, excuse me, another crisis. However, the asset class is under considerable stress, mainly driven by deep secular changes in the global economy, but also by country-specific manifestations that have certainly exacerbated risks and concerns within the EM universe. Now, the harsh reality, as Marcos just briefly detailed, is that EM growth continues to disappoint, and it seems like every month most of our downside growth revisions are centered on EM countries. The jury, or at this point right now, the jury is out on whether the emerging markets are still viewed as the principal global growth engine, given that so many of its most important players are facing noted downside growth constraints. Just this month, we took downside revisions to Brazil, Russia, Turkey. As mentioned, Brazil is in the midst of another recession with obviously the projected fiscal tightening bearing contractionary effects. You have high inflation necessitating higher interest rates. The Petrobras scandal and concerns over the Rousseff administration is undermining investments. And if that weren't enough, you have a country dealing with a water and electricity crisis that is certainly impacting sentiment and investment. Russia, for all intents and purposes, remains a complete mess. Turkey, we also took some downside growth revisions there. I think the Turkish situation, obviously, this is an economy that gets a huge boost from lower oil prices, but the increased meddling by the Erdogan administration is certainly threatening to upset this economic stability that we've seen in Turkey in years past, and obviously impacting investments. South Africa is also another country with significant downside growth risks, and I would also add to this mix at this point Mexico. We left this month. We didn't take any action on Mexico, but in the prior months we have, and at this point we're looking at a lower growth profile for Mexico in the midterm to long-term view. Our sense is that while we're still going to get some positive growth in this area of the world, there's now serious reform delays and implementation risks given the weak popularity of the Enrique Peña Nieto administration. And the reality is that, you have a recovery that thus far remains one-dimensional and tied primarily to the U.S. expansion. So if we could go on to the next slide. It's really, at this point, it's really no surprise that much of the subdued growth trends across the EM space have been exogenously driven, and particularly it's basically a function of reduced external demand support, mainly via the self-inflicted deceleration that we've seen in China, and that has in turn worsened and made the backdrop for commodities and commodity exporters a lot more complicated. Moreover, I sense that for a number of months now, we've continued to deal with these uncertainties over the global monetary policy dynamics, the strength of the dollar, the shape of the yield curve across the developed bloc, and that has certainly impacted critical investor sentiment towards the region, and it's a region at the end of the day remains very much dependent on foreign capital, so these manifestations are certainly bearing considerable weight on the EMs as a whole. And ultimately, the confluence of both of these factors has spread to undermine domestic demand conditions, and given less than hospitable country-specific dynamics, you've seen significant cutbacks in investment in foreign capital, and really an overall dire outlook for the EM asset classes as a whole. So if we move to the next one, the next chart what we have here is just basically trying to speak to the underlying vulnerability pressures that we see throughout the emerging markets. We put this report out every couple of months or so. And last time we had this was in October, and we just released this last month. And it's basically looking at some key economic variables and trying to assess the vulnerability of each emerging markets. And as you can see, there's considerable deterioration across the board. I think Asia probably seems the least vulnerable on the EM side, but as evident by this chart, China is certainly losing momentum as growth is weaker, credit growth remains robust, and the exchange rate probably seems a little bit more expensive at this point. Malaysia certainly ranks among the worst performers, given that FX reserve levels are well below the stock of short-term debt. When we look at LATAM continues to exhibit less resilience. Obviously, Brazil ranks right up there in the vulnerability rankings. Mexico has also come into light in recent months, given the growth on the performance, the fact that debt-to-GDP ratios have been on a steady climb. In EMEA, obviously, the cast of characters includes Turkey, South Africa, and Russia. I think Turkey probably remains the most controversial of all of these. Most of the deteriorating vulnerability scores are a reflection of the fact that you still have a country with a very delicate external finance position, underlying political risk. But that being said, we have to remember Turkey benefits from lower oil prices. The external financing position is improving on a day-by-day. Inflation has decelerated, and all expectations are that the political climate will ease after the June elections. Of course, there's Russia, and we sense Russia would probably rank lower than current estimates show, given the fact that you still have a recession, rising inflation, volatility in the exchange rate, and a lot of the shocks that have been magnified by these risk factors are not being captured in this analysis. And this is particularly speaks to terms of trade shocks and political hazards such as sanctions. So we move to the next chart. This is basically the impact that we've seen across the emerging market universe in recent months. Again, this is the confluence from external uncertainties, whether related to global monetary policy dynamics, even with the ECB and the BOJ in full quantitative easing mode, or whether related to a stronger dollar, Chinese growth worries, the end of the commodity super cycle, and of course, country-specific dynamics. Amid all these secular macroeconomic and policy trends unfolding across the global economy, the market has continued to struggle, and they've continued to struggle in terms of finding a floor for oil prices, a ceiling for volatility, and a window into the future U.S. monetary policy dynamics. As we've seen this past week, the FOMC delivered quite a dovish statement, and this certainly was probably not as expected by most market participants. So when you add all these exogenous factors and the fact that you have these country-specific developments, weakening growth prospects, the fact that you still have unattractive real yields, narrowing growth differentials over advanced economies, it seems quite reasonable at this point to ask oneself whether there are any compelling opportunities to be invested in the EM space, or whether we should just migrate out of the asset class, as many are doing. We'll go to the next chart here. Our view on the EM asset markets is geared on several fundamental drivers. For one, we expect volatility to remain high with pockets of moderation. That being said, second, we're of the view that global quantitative easing, primarily via the ECB and the BOJ, is not and will not be sufficient to offset the expected normalization of U.S. monetary policy. And lastly, despite the U.S. Fed's latest dovish tendencies, a higher path for U.S. interest rates is expected and will continue to support this dynamic of strong dollar, weak commodities. And all told, I think these conditions will ensure that emerging market assets remain in the firing line. And at the end of the day, investors will continue to adjust to the reality of lower returns, higher credit risks, and less abundant liquidity. Our EM investment approach is set to basically center on both external and local market opportunities, and we continue to emphasize high-quality credits in the hard currency space, primarily by identifying countries with strong underlying credit fundamentals, primarily fiscal positions, stable and improving political situations, comfortable FX reserve levels, a debt profile that can withstand these financial shocks and these global market shocks. And at the end of the day, we're looking for countries that have the policy flexibility and maneuverability to better equip and handle these highly adverse global macro backdrops. On the local market front, we believe that the combination of weak global growth, disinflationary global trends, and low commodity prices, along with the projected and cautious gradual tightening cycle in the U.S., should create some selective opportunities for local rates and bonds. And all in all, we do see some compelling opportunities in select markets, primarily where the rate hike cycle that the market is pricing in is a lot lower than we expect, and where total carry opportunities adjusted for risk may still present some attractive opportunities there. Importantly, on the FX side, we remain very cautious and selective. So what are we looking at in terms of where do we think there's value, where do we think there's not? On the external credit side, I think our focus right now is obviously in India. This is one of our top picks. It will continue to be our top pick because India is basically pushing all the right buttons in terms of the reform agenda, in terms of improving growth dynamics, reduced fiscal deficit and external balance pressures. Inflation has also improved considerably, and you also have a policy structure that seems considerably more prudent, more market-friendly. We remain optimistic on Indonesia. I think we've seen considerable tightening on Indonesian CDS spreads in the past couple of weeks, but we think there is room for further spread compression given that fundamentals here look good, especially with a structural reform bias in place. This is an economy that also benefits from lower oil prices and broader political stability. Colombia and Mexico may surprise you that they're there. These are two economies that certainly get hit via this oil price dynamics, but our view is that as we push further out with the Fed hiking rates, with these China growth rates becoming more prominent, I think that'll lead investors to greater selectivity and segregation within the EM space. And Mexico and Colombia and LATAM certainly stand out because they do have that policy flexibility and maneuverability to adjust for this climate. So yeah, oil prices are lower, but in Mexico you have a hedge program that keeps the country covered for this year. They've also enacted some spending cut measures that should help support the situation in 2016, and Colombia has the vaunted fiscal responsibility law, which should help them limit these adverse shocks. Then there's Turkey, and I think again Turkey is a very controversial view because all the political manifestations that have been taking place. Because obviously this is a country with noted external financing vulnerabilities. But to be honest, we still like the Turkish story. I think at the end of the day, they could stand on their own 2 feet. Amid this whole global climate, we do expect political tensions will ease after the June elections. We also sense the market doesn't have a real good grasp of this heterodox monetary policy stance conducted by the central bank, which is, for the most part, is succeeding in keeping inflation within line, at least to this point. And at the end of the day, this is a country with sound fiscal and debt profile measures, and we see very little low risk of a downgrade. Our underweights are no surprise. Brazil, which is another basket case at this point, we really can't be overly we can't stress our bearishness on the Brazil economy enough. Russia, again, another very disappointing story there, given the climate of political uncertainty, an economy in a recession, exchange rate volatilities, and so forth. And the other two I won't even waste your time with because Venezuela and Ukraine, I know some investors are still heavily focused on these two markets. Venezuela, we just can't stomach the uncertainty that we see in this space, and I think our best case scenario would be for an end to the Maduro regime. I'm not saying that this is the end of Chavismo as we see it, but I think right now there are serious risks that Maduro is ousted from power given the underlying social pressures and the weak structure within the PSUV party. It's increasingly divided. I think Venezuela gets by for this year in terms of avoiding a default, but obviously next year is a different ballgame with oil prices at current levels. But all in all, just a very difficult climate there for Venezuela, as it is for the Ukraine. I think default risks remain very much on the table for the Ukraine, and obviously the political crisis there is another unsettling factor. So we move next to our local market view. What I'm trying to capture here is give you some perspective on how we stand on the local market front. So just to detail this matrix here, we'll take Russia for example. It's right there in that middle bracket where we are underweight the Russian rates and bond space, given the political and underlying macroeconomic dynamics in Russia, but we're market weight on the ruble. We think the ruble has sold off considerably. Obviously, the consolidation in oil prices in the past couple of months has provided a cushion. And I think we do remain market weight at this point because we don't expect additional rate cuts in Russia. I think our key calls here, obviously, are overweight views on Indonesian and Indian rates and bonds. We do sense the rate cutting story there has a little bit more to go on in the coming months. Maybe not as much for Indonesia, but Indonesia at this point is more of a bond play there, local bond play there, where we do see some attraction in that space, where India, obviously the rates and the bonds both look attractive, as we expect the central bank to continue cutting rates there, as we expect the reform agenda to continue gaining momentum. Obviously very bullish on the currency as well. I think we do have a little bit more to go, both on the Indian rupee and on the Indonesian rupiah. The market weights that we detail here on the FX side, particularly Brazil, China, Chile, Romania, South Africa, not much of a surprise there. I think we continue to see a gradual adjustment in China. Chile, also a concern. You know, that market weight could go both ways. Obviously, with copper prices coming down, the risk is that we see further pressure on the Chilean exchange rate. But obviously, growth has improved a bit. We do not expect the central bank to be moving any time in the coming months. And then on the rate side, Brazil looks particularly attractive. I think the market is a little bit too heavy in their in their rate hike expectations. I think the market was expecting around 75 basis point of rate hikes, where we expect only 50 at the next meeting. So I think that should provide some opportunities on the curve, the short end of the curve. South Africa is another rate play that we see is particularly important, because the market is pricing in quite sharp rate hikes this year, and we don't believe that will happen, given that the growth and equilibrium, the growth and inflation equilibrium remains very much supportive for no change in rates in South Africa. Malaysia, another underweight there on the FX side, and obviously we don't expect much action on the rates or the bond space. And then in that middle packet, we have Colombia, Mexico, Korea, Thailand, and Turkey. Mexico is mostly a local bond play. I do sense there are some opportunities in the long end of the bond curve there, primarily 10-year sector. This is an economy with still fairly strong fundamentals, and more importantly, the renewed uncertainty over the timing of the U.S. Fed liftoff is supportive. Colombia, you know, we remain long-term constructive on Colombia, so that's why we chalk that in there. Not much on Turkey. Obviously, I think the uncertainty will remain in place until the elections. I don't believe that with the Turkish lira at current levels, the central bank will venture to continue cutting rates. I think we'll see a pause for for some months to come on Turkey, but that does not mean that the rate cutting cycle is by any means over in Turkey. And with that, I think I've spoken enough. I will stop here. I think the next chart that we have here for you guys is basically detailing our key forecasts for the region, for the EM space. But as I said, I'll stop here, and I look forward to your questions and your comments. Thank you.
Okay, one question here from looks like Raphael here. The recommendation in countries with better GDP growth like India, Mexico, Indonesia, and the underweight in Brazil, Russia, Ukraine, Venezuela. Can you look at these? From an equities valuations perspective, and go into detail about the risk score?
Aryam, I'll leave you this one.
Yeah. Well, we don't go into we don't get into it from an equities valuation perspective. This is mostly a fixed income view. I do sense when you look at Venezuela and the Ukraine, there are probably some attractive valuations. As I mentioned, we don't get heavy into the valuation space. These are more directional views on where you see the markets going, and mostly driven on macroeconomic and to a lesser extent technical factors. So no, I mean, it really all depends. I think there are certain attractive valuations out there in the more controversial and high risk emerging market plays, but I really also think it depends on your adaptability and capacity for risk at the end of the day. Obviously, these are high-yielding credits, but they come with a very expensive risk component and a great deal of uncertainty, given the global backdrop that we're dealing with, primarily with Venezuela on the threat of a default and a threat of a major political crisis, and the same thing for the Ukraine. And no, and with regards to equity valuations, again, we don't delve into that space with a great deal of frequency.
Right. Just following up on Rafael's questions about the risk score. The risk score takes into account several imbalances that we try to map here for the key emerging markets. What we do look at is a weighted average of several indicators. Actually, it's not even a weighted average. It's a simple average of several indicators. We take into account capital inflows. We take into account external financial situation like foreign reserves as a percentage of short-term debt, net external debt, the amount of securities issued abroad, the twin deficit, so current account and fiscal deficit, domestic credit, if credit has expanded too much over the last 5 years, and also GDP and inflation. So it's just a mashup of everything here. I did get another question in the chat from, I can't identify who it is, but it's about the Brazilian currency. So I'll probably take that one as Brazil economist. I think for the Brazilian currency, it's quite difficult to get into a point forecast. So I'll try to adopt here a different strategy. I'm going to talk about 3 different scenarios that I have for Brazil. That's my view, and we can be flexible on the probabilities here. So we have our baseline forecast, which is a story where Brazil doesn't get a downgrade to junk status. Joaquim Levy tries to tighten policy. It doesn't actually get to the target of 1.2 percentage points for the primary surplus. I think that 0.6% is more likely, more achievable. Petrobras issues a balance sheet that is audited, and it comes within market expectations, which is a pretty wide range of between 8 and 80 billion loss, rise in loss of assets. And in this scenario, I see the central bank tightening to 13.5, and the real should be able to trade around 3.20 to the dollar until the end of the year. This is our baseline scenario. We can attach maybe a 60% probability to it. Then you have an adverse scenario with a 30% probability that Brazil does get downgraded to junk. This is a scenario where the fiscal adjustment promoted by Levy simply doesn't work. Congress doesn't approve the measures. Levy is probably ousted from the finance ministry, and things just turn sour, and the real would look for another bottom at around maybe 4 to the dollar, which is our historical low that we saw in 2002. In that case, needless to say that the local curve would just go to the roof, and the central bank would try to just defend the currency by hiking rates to 15% plus. But this is a 30% probability scenario where the real would reach to 4 to the dollar. And then you have an outlier scenario, which is, well, the honeymoon scenario. And this scenario is obviously not very likely. We probably attach a 10% probability to this scenario. This is a scenario where, well, the adjustment is very well made. The suffering is not as deep as we expect. The economy performs better. Dilma and Levy have a honeymoon together, and the real soars and rallies to 3 to the dollar, and the VI curve just goes back to normal. So mainly my view is that both the DI curve and the real, they are pricing, investors are pricing in too much of an adverse scenario. I think there are some positive outcomes to come. Obviously, there's the risk of things go off rail, but I'm fairly neutral on the real. I think that we are trading at 325 now, and I think 320 or the current levels, it shouldn't go much beyond it. I think if whatever goes beyond it, it's a bit of an overshooting, where Brazil could be downgraded. So if you look at the DI curve, I was looking the other day, the long end of the curve is like 14%. So at 14% to 10 years, there's no government that can survive that. And so the DI curve is not only pricing in a downgrade, but it's pricing in an insolvent country. So I see some opportunity in the long end of the curve and also in the BRL.
Another question here from John. Are you seeing any sign of Mexican household spend rising? And if so, to what extent could that make up for the loss of government spend in the short term?
Aryam, do you want to take that? Hello? Oh, I had my apologies. I had the mute button on. But no, we're not seeing much activity in terms of household spending, at least not yet. Again, this recovery in Mexico remains very, very one-dimensional, primarily led by the manufacturing upturn that is so closely tied to the U.S. recovery, and we do not see that recovery spilling over into the domestic side of the economy. It's taking a little bit longer than everybody expected. On top of that, you just have these recent fiscal adjustment measures that were just announced. These will hit primarily on the investment side and not much in consumption, but at the end of the day, they do hit growth on the whole for Mexico, maybe not as much as many were expecting. But really, it's a difficult structure there in Mexico. I really don't see the household sector providing much of an impetus to growth this year. We will get a lift-off because credit conditions are somewhat more improved than they were several years ago. Rates are, for the most part, low. The financial sector reform is certainly progressing, at least according to expectations, and trying to reach to the deep sectors of the Mexican economy and to a number of households in Mexico. So I think that is also bodes well in the medium to long term. But in the near term, I don't think household spending would really provide much of a pop to the Mexican economy. All right, if there are no more questions, I think we will call it a day. It is Friday. So, James, do you see any more questions? Marcos?
Nothing on my side here.
Nothing here, but for everyone who still has questions, please feel free to forward them to us, and we'll make sure they get to the right person and back to you. But thanks for joining us. Once again, forward us any of your questions, and if you need any more information, please feel free to visit our website at www.oxfordeconomics.com. Have a great afternoon and a good weekend. Thank you.
Thank you, everyone.